Ladies and gentlemen, investors have no clue about the dangers we are facing in the markets right now, and it could possibly be worse than even I have predicted. In this video, we're going to go over exactly what caused the massive sell-off that we saw in the markets today. I'm going to break down all the news, the facts, and the data, and then I'll give you a conclusion of the risks that we are facing ahead. So everyone, let's not waste any time. Let's get straight into it. Okay, first things first is this, everyone. The Dow dropped more than 500 points today. The Nasdaq sank over 2%, and this is what's causing the big fears right now with what's going on with Russia and Ukraine. Now, I'll get into what happened with Russia and Ukraine later in the video, but let's go down and see exactly what happened in the markets today and why it happened. Okay, first things first, this is definitely spooking the markets, everyone. Brent crude oil has hit $95. And the reason why I did this is because Russia is a big supplier of fuel and energy. So with energy prices already skyrocketing and that being a huge contributor to the CPI, now it's getting worse. Then that means inflation's going to get worse. That means more rate hikes from the Fed. That means the stock market has to price in these more rate hikes. And it seems like every day now banks are saying, no, there's going to be 4 rate hikes. No, 5, 6, 7, 8. Whoever can call the most rate hikes this year wins the prize. But what we also saw today is a flight to safety. Look at this, everyone. This is why I say you always need a little bit of gold in your portfolio as a defensive asset and also as a safe haven. Gold was up 1.26% today when the Nasdaq was down 2.7%. Again, with a flight to safety, we saw the 10-year US Treasury yield fall below 2% because people are worried. They're wanting to put their money maybe in the stock market into some safe haven asset like bonds, wait for stocks to fall, and then rotate back in. Again, the Dow Jones down 500 points today, down 1.4%. The S&P got hit much harder, down 1.9%. And the Nasdaq, the high growth tech sectors, continue to get hit harder and harder because these companies are more vulnerable to interest rate hikes and are more vulnerable to inflation that will erode the value of their future earnings. The Nasdaq was down nearly 3% today. And people, I've been consistent. I've been telling you this downtrend isn't over. And I'm not like some of these other YouTubers that flip-flop every other day. When it's green, oh yeah, buy. I told you to buy. I told you it's going to go up. Or when it's a red day, they say sell. I told you to sell. I told you it was going down. And they just keep flip-flopping and it's very confusing. But I've been consistently telling you, don't get caught up in the short-term volatility. I'm waiting for at least a 20 to 30% decline for me to start dollar cost averaging back into the stock market. So then even if it falls further, at least I have a margin of safety and at least I'm not buying in at all-time highs. Bitcoin also is facing some huge selling pressure, but it does have a lot of support at 42,000. I'm seeing every time it hits that 42,000 level, it tends to bounce. But we'll see if it does eventually break that level. So Bitcoin down around 2.7% and Ethereum broke 3,000 as well. But people, things are definitely getting very serious and the risks are building up higher and higher. So let's have a deeper look today to see why the markets are really selling off and what's behind all these moves. Well, the first piece of the puzzle, about 2 hours before the close, the White House announced the increased risks of Russia invading Ukraine and said it could happen during the Olympics. Now, this is all speculation. We don't have any facts. And, me personally, I don't really trust the news that comes from the mainstream media or what the White House may speculate. We all know that they don't really like Russia, but again, we don't have the facts. This is just politics, and with politics, we don't always get the facts until maybe 10 years later. But if it is true and if an invasion is imminent, then this sell-off may just be beginning. Now, also, when I've researched history to see how the stock market performs during war times, well, what normally happens is investors sell off first. We actually see a lot more selling before the conflict begins, but then once the conflict starts and once we have more certainty on what's going on, then we could see the stock market start to recover. And also with conflicts, it is very inflationary. We saw record inflation, record money printing during World War I and World War II. So if we go into another conflict when inflation is already at all-time highs, it is just going to get worse. And you know how the old saying goes, when all else fails, they take you to war. And this is what some commentators are saying. The Ukraine headlines had a little bit to do with the sell-off, but what they really think is happening is the Federal Reserve doesn't have a plan. And that's exactly right. We have a split Federal Reserve. We have some officials saying they need to do a 0.5% rate increase. They need to have an emergency meeting. But then you have all the other people on the board saying, no. We just need a tiptoe baby step. We don't want to break anything. We don't want our retirement portfolios, to go into the toilet. We want to keep this bubble going and just do, a 0.25% rate hike. And I'm sure that will help with the 7.5% inflation we have when we all know it's really 15%, people. We also have other commentators saying that it's very likely we're going to see another 10% pullback in the markets. I think growth and defensive stocks will likely outperform, which I do agree. Maybe they won't fall as much, but I do think if we do get a big sell-off, they will get caught up in it. But people, it's not just this. What I've been warning about is we're seeing a weakening economy. We're seeing inflation is absolutely destroying consumer confidence, and we just got another piece of data today. And why us as investors, we need to pay attention to this, because if consumers aren't spending, so that means companies' revenue growth is going to slow. Then that means they may have weak earnings in Q1, and their stocks are going to fall like what we saw during this earnings season. Look at this, another negative sentiment on economic front. The University of Michigan preliminary consumer sentiment reading for February came in at 61.7, rolling from 67.2. But what I'm sure you probably want to know is, okay, what does all this economic and stock market jargon mean for you in simple terms? What this means is we're seeing continued selling pressure in the markets, with the markets down over 2% today. We're seeing a flight to safety with investors going into bonds and gold, which normally perform well during highly uncertain times and a stock market sell-off. We're seeing inflation getting worse, consumer sentiment falling, and what this tells me, this all points to we are still just at the beginning of the stock market sell-off. And again, what I'm personally waiting to do, this is not financial advice, I'm just simply waiting patiently on the sidelines, building cash, also dollar cost averaging into gold, because I think safe havens will perform well, even though it hasn't performed great over the past 10 years. The previous 10 years before that, it went up nearly 500%. So again, my targets for the S&P 500 is a 20 to 30% decline for me to start dollar cost averaging in, and for Bitcoin it is 25,000 to 20,000. I'm not trying to time the bottom, nobody can time the bottom, I'm just trying to get a good chunk. But everyone, what do you think about all the issues that are going on right now? Let me know. Now, for all my loyal viewers and subscribers still watching, you are awesome. Thanks for watching, I'll see you in the next video.